Understanding the de minimis requirement for qualifying free zone persons. To maintain eligibility for the free zone corporate tax regime, a free zone person must meet specific requirements, including the de minimis requirement. This requirement plays a crucial role in defining the boundary between qualifying and non-qualifying income, allowing a free zone person to earn a limited amount of non-qualifying income without losing its qualifying free zone person status. The de minimis requirement establishes a threshold for the amount of non-qualifying revenue permissible within a given tax period. 1. What is the de minimis requirement? The de minimis requirement refers to a financial threshold applied to the non-qualifying revenue earned by a free zone person in a specific tax period. For a free zone person to remain eligible for the benefits of the free zone corporate tax regime, its non-qualifying revenue during the tax period must not exceed the lower of the following two thresholds. AED 5 million, or 5% of total revenue, calculated by taking the non-qualifying revenue as a percentage of the total revenue generated. By setting these thresholds, the de minimis requirement essentially allows a qualifying free zone person to generate a small amount of non-qualifying income, either AED 5 million or less than 5% of the total revenue, without risking disqualification from the free zone corporate tax regime. 2. Purpose and importance of the de minimis requirement. The primary purpose of the de minimis requirement is to provide flexibility within the free zone tax framework. This allows a qualifying free zone person to earn a minor or incidental amount of non-qualifying income without adversely impacting its eligibility for the free zone corporate tax benefits. Non-qualifying income refers to income derived from activities not recognized as qualifying activities under the free zone regulations. This threshold acknowledges that businesses may inadvertently or occasionally generate non-qualifying revenue. Provided that this revenue remains within the de minimis threshold, it does not negatively impact the free zone person's eligibility for the 0% corporate tax rate on qualifying income. The flexibility offered by this requirement is particularly beneficial for businesses operating in free zones that might otherwise risk disqualification due to minimal non-qualifying revenue. 3. Treatment of non-qualifying income under the de minimis requirement. When the de minimis requirement is met, the qualifying free zone person is allowed to treat certain non-qualifying revenue as qualifying income. In practical terms, this means that income falling within the threshold specified under the de minimis rule will be eligible for the 0% corporate tax rate, provided that it does not exceed the stipulated limits. The revenue subject to the de minimis requirement may originate from activities that do not directly fit into the first two recognized categories of qualifying income. These categories generally refer to income generated from transactions with free zone persons and income from non-free zone persons related to specific qualifying activities. By treating incidental non-qualifying income within the threshold as qualifying income, the de minimis requirement provides leeway for free zone persons to conduct certain limited transactions without losing their tax benefits. 4. Revenue adjustments for de minimis requirement calculations. When calculating the total amount of non-qualifying revenue and total revenue, for assessing the 5% threshold, adjustments are made to exclude certain types of income. These adjustments ensure that only relevant revenue streams are considered in evaluating compliance with the de minimis requirement. Specifically, the following types of revenue are removed from the total non-qualifying revenue and total revenue calculations. Revenue from a domestic or foreign permanent establishment. If the qualifying free zone person operates a domestic or foreign permanent establishment, revenue generated by that establishment is excluded from the de minimis calculations. This ensures that income attributable to international or domestic branches does not impact the free zone person's eligibility status. Revenue from specific real estate transactions. Revenue associated with certain real estate transactions is also excluded from the de minimis calculations. These transactions include commercial property within a free zone. Revenue earned from transactions involving commercial property located within a free zone and conducted with non-free zone persons does not count toward the de minimis threshold. Immovable property transactions outside of free zones. Revenue derived from transactions involving immovable property that is not classified as commercial property within a free zone is also excluded. 5. Impact of meeting or failing to meet the de minimis requirement. Meeting the de minimis requirement confirms that a free zone person remains within the boundaries of allowable non-qualifying revenue and can continue benefiting from the 0% corporate tax rate on its qualifying income. When the requirement is satisfied, any income that doesn't directly fall under recognized qualifying income categories but is within the threshold limit can still be treated as qualifying for the 0% tax rate. On the other hand, failure to meet the de minimis requirement results in disqualification from the free zone corporate tax regime. In such cases, the free zone person may become subject to the general corporate tax rate of 9% on its non-qualifying income. This underscores the importance of closely monitoring and controlling the volume of non-qualifying revenue to ensure continued eligibility under the free zone corporate tax benefits.